Hey, this is Garrett Gunderson, and on this week's episode of The Drop-In, I'm having a conversation or presentation for a group called Renatus, which is a real estate investing group that I'm an instructor for. And I'm going through the biggest investing mistakes and really differentiating between investing and gambling, because a lot of people are taking too much risk and speculating, and it's costing them money over the long term. And getting into three-dimensional investing, which has to do with cash flow, equity, and being related to it for personal fulfillment. More importantly, making money on the buy, how you become profitable and cash flow from day one, or find in times of distress like today how you can make sure to salvage and solve someone's problem, but be profitable with what you're doing by doing that. We're talking about the biggest marketplace's advantages and how to think about money and investing in general. And ultimately, this is going to be about becoming a better investor. So enjoy.
I think when it comes to investor DNA, a lot of people have a lottery syndrome. They want to invest in things that they don't put any effort towards, and they want to believe that somehow investing is about luck and it's about being completely passive. But if you want to create passive income, it takes activity up front to create that recurring revenue. And most people that get into a passive nature watch their money pass them by as they hand it off to so-called professionals that are often just posing because they're truly salespeople. And when you don't have knowledge about what you invest in, that is not investing, that's gambling and speculation. So I believe that part of the benefit of investing is when we can make it three-dimensional. The first dimension is when you can create cash flow from day one, you're in a much more solid position because you're making money on the buy up front. Number two, the less involvement it requires from you over time and can still provide that cash flow, the more equity can happen. We see this in long-term rentals. Cash flow comes in, rents go up over time, equity goes up because of that, simply because of whether it's inflation like there is today, or it's a low interest rate environment, or simply higher demand in those areas, or whatever those different factors may be. So my recommendation is find three-dimensional investments. The first thing is cash flow. The second is have that equity grow. And third is choose something that brings you personal fulfillment. This is where it becomes nonlinear, where you have a strategic advantage because you're interested, because it's part of your investor DNA, because you're driven to learn about it, you're driven to get involved in it, when everyone else is kind of playing very small amounts of time, relying on people that aren't really experts. And simply, this is where you have an amazing advantage in the marketplace. So three-dimensional investing, cash flow, equity, and personal fulfillment. And I believe part of investing is the enjoyment you get from the experience. And it's a lottery syndrome to think I'm going to send my money off and then one day it's going to be worth more money, because you never actually garner the two things that will give you the deepest advantage in the marketplace. If we invest without the knowledge of the return, when it's going to pay off, how it's going to pay off, how to mitigate and manage the risk, why it would work, when it wouldn't work, what economies are, like those basic factors, that is not investing, because we never gain mental capital and relationship capital. We become better investors when we gain knowledge, insight, strategy, skills, tools. That's our mental capital. You start to learn more so that you could be more effective. But the second thing is, as you invest in certain things, you start to meet the right attorneys, the right bankers, the right, realtors, or whatever it might be. You start to build relationship capital, and these start to stack the odds in your favor to become a better investor. Most people are trying to get the best investments to come to them, luckily, rather than become a better investor and be responsible for the outcomes. So most retirement planning, unfortunately, is only focused on accumulation for one day, someday, neglecting cash flow over a lifetime. That notion of retirement planning comes down to you having the belief in three things that are absolutely misleading. Belief number one: it takes money to make money. It doesn't take money to make money. It takes mental capital and relationship capital. It takes resourcefulness and serving others and value creation and solving problems. It takes adding value when it comes down to it. That's where money comes from. It's a byproduct of value creation. Money follows value. So if we believe it takes money to make money, then we get into this notion that you just have to scrimp, save, sacrifice, budget, and delay your life so that one day, someday, you can finally be wealthy. But the problem is that requires a massive amount of energy. It's no fun. It absolutely sucks. And nobody wants to hang out with someone that's miserable because they're just scrimping their life away. Nobody's like, oh, you got to meet my friend. He's a miser. He's never spent money for 10 years. You'll always pay for the meals or he'll never go. That's no fun. Yet that's what retirement planning tries to convince people to do, right? The second notion that you have to buy into for accumulation and retirement planning to work, but it's working for them more than it works for you, is that high risk equals high return. Risk means our chance of losing. Increasing our chance of losing doesn't help us win. Renatus is about educating you so you come with more mental capital so you can reduce and manage your risk. Think about it. A bank, when they're being effective, they're effective at managing risk. If you want to get a mortgage, they want a down payment. Don't give them enough down payment, they want private mortgage insurance. They want one appraisal if it's a non-jumbo loan. They might want 2 appraisals if it's a jumbo loan. They want to see your taxes. They want to see your seasoned funds inside of your accounts. They want to know your credit score. Those are risk mitigation processes. And they might even put personal guarantees on that. Yet when we invest in retirement planning, we're just supposed to put our money into a stock that if that company goes out, bondholders have a priority. Everybody else has a priority over the stockholder. You have no control over what's going to happen to that company. And somehow that's called investing. Why? Because everybody does it. Thucydides said if 50 million people do a foolish thing, it's still a foolish thing. And unfortunately, that's how a lot of people invest, without knowledge. So if we're investing and we're skipping the mental capital, we're inviting risk. So first thing is, if we believe it takes money to make money, that becomes a defeating, debilitating philosophy that doesn't have us look resourcefully at anything like partnership, private funds, bank funds. It absolutely decimates people's mindset. Then the second thing is to believe that high risk equals high return. People that don't take risk tell you that. They're having you take risk on your money while they get the return, right? And then the third misstep or misinformation around retirement planning is you're in it for the long haul. The long haul? Come on. This isn't like old Heinz ketchup commercials, if you remember those, where someone would just sit there forever and then the good thing would happen to them because they waited forever for the stupid ketchup to come out of the bottle. The best things don't come to those who wait. The best things pass those who are waiting by. And this is the unfortunate thing about retirement planning. Set money aside on a regular basis, wait for it for 30 years or longer to pay off, hoping compound interest will work, defer your taxes, and you might be in a higher tax bracket in the future, and just hope for the best in a changing economy where many of those companies won't even make it for 30 years, and yet that's the notion that we've been taught? That's erroneous. It neglects cash flow.
Hey, pardon the interruption, but I've got a gift for you. Actually, 2. Killing Sacred Cows, my New York Times bestseller, hit #1 on Wall Street Journal, and my most popular book of all time, What Would the Rockefellers Do? Killing Sacred Cows is like a permission slip to have more success and avoid the missteps and myths around finance. And what would the Rockefellers do is taking these kind of big billionaire technology and ideas and bringing them to the masses. So it's a step-by-step financial system where you can start with as little as I did when I was 19 at $50 a month. So if you go to garrettgunderson.com/offer, give me your email address, and I'll just shoot those books right over to you so you can enjoy and learn at your own pace.
This is my problem with retirement planning is, retirement's kind of a concept that convinces us that we need Labor Day off next Monday, right? When we do things that we hate every day, we're like, God, we need a day off because my life sucks, because I'm trading my time for money, because I'm working for the man that I don't like. I'm doing the things that I don't want to do because I got to pay off these loans that I got into in school. Oh, don't worry, you don't have to pay those now. Those are just forgiven, so it's all good. I forgot about that. Screw you people that worked and paid your own way. Doesn't matter. This is the problem, is it lacks responsibility, and retirement planning lacks responsibility. It's always about one day, someday, and someday never comes. And the neglect of understanding cash flow is the main problem. So think about people that get to retirement and they go, all right, I'm going to build up a nest egg, and then they have to rely on 3 things for their lifestyle. Number 1, that interest rates provide a good enough cash flow. Because remember, they didn't buy real estate, they bought mutual funds. You know how good mutual funds are at creating cash flow? They suck. So now they have to switch it to something else and hope that that's going to provide cash flow. But what if interest rates were like they were the previous 20 years, exceedingly low? That's great for a business owner and real estate investor, terrible for a retiree. What are they going to do? Number 2, what if taxes go up? We've spent $30 trillion in the United States alone that we haven't provided a balance sheet for with an asset attached to it. We're $30 trillion in debt. You think they might raise taxes in the future? Well, if they do and someone's in retirement on a fixed income, their lifestyle goes down. And the one that we've watched massively in the last 2 years is retirees get screwed because of inflation. Their purchasing power decreases faster than their height. As people get really old and they just start shrinking, and that's what happens. Inflation just starts to confiscate that wealth. So they have been taught their whole life, set it and forget it, invest early, often, and always, diversify, Take high risk, though, with stocks to get that return. Diversification will help minimize some of that risk, but you got to have risk to get return, and wait for 30 years for compound interest to save you, because Einstein said compound interest is the eighth wonder of the world. Guess what? That's a lie. Einstein never said that. Everybody that tells you that is misquoting Einstein. Einstein went to a conference in Austria where he said compounding numbers were the eighth wonder of the world. Security National Life misquoted him and said compounding interest. Compounding interest and compounding numbers are not the same thing. Compounding interest exists for the banks. Let's talk about why it's so good for them. If you're a bank, what do you want from people? Money. How often do you want it? All the time. How long do you want to hold on to it for? As long as possible. And how much do you want to give someone back when they ask for a return? As little as possible. That is the rules of the institutions. It's why retirement planning is good for the institutions and not the individual, because it has you neglect cash flow. No bank is trying to retire. They're trying to create cash flow from day one and mitigate their risk. And Wall Street and the banks are selling to everyone else, hey, you should just accumulate. Plan for retirement. I'm here to say that's not a really good plan. Let's have you design a life you don't want to retire from. And my objective here is to give you the framework for financial independence as an alternative to retirement. See, most people think retirement's a 30-year proposition. And by the way, the U.S. Department of Labor says 95% of people in America cannot retire at age 65. It's not from a lack of effort, it's from a faulty framework. That framework is so dangerous and dogmatic and yet programmed in the majority of Americans. So what's the alternative? Financial independence within 10 years. The first thing is we're going to use a different methodology that leads to more certain results that doesn't require you to budget. The first thing we're going to do is help you plug financial leaks. There's 4 ways to plug financial leaks. Save on tax, save on interest, save on non-performing investment fees, and save on duplicate coverages or improper structure with insurance. So the 4 I's: IRS, interest, insurance, and investments. It's plugging financial leaks, boosting your bottom line, not trying to save more money by cutting back, but by simply reclaiming the money that's rightfully yours. That's the first step in financial independence, is find cash. Step 2, let's engineer your wealth by figuring out what amount of money needs to come in per month for you to live your basic lifestyle. Not the best lifestyle, just the financial independence is the basic lifestyle to begin with as the first foundation. Then let's reverse engineer and say, A, is your foundation handled so no money slipping through the cracks? B, do you have stability and safety for sustainability so it's not a flash in the pan when there's a changing economy? And then C, are you utilizing your investor DNA to create cash flow? Well, let's move to the third step. So the first one's plug financial leaks. The second one is engineer wealth. Reverse engineer and figure out how to create the cash flow to cover your basic expenses. Then the third thing is find any lazy assets that don't produce cash flow and turn them into a cash flowing asset. Maybe that's paying off a loan. Maybe that's buying something that cash flows, whatever that might be. And then the fourth thing, financial independence, is the thing they don't want you to know, that they're never going to teach you because you have to opt out of the system of indoctrination. You know that system that says go to school, get good grades, get a job, the higher degree you have, the more money you'll make, you can get a pension and save a bunch of money, and then one day, someday, you'll be able to retire. Guess what? That plan sucks. It's antiquated. We've watched pensions get decimated. We've watched funds get decimated. We've watched people work so hard and so long and then invest in things they know nothing about, because the world has indoctrinated us to think it's too complicated and we have to trust everyone else. And you know what? Why would we ever trust Wall Street? Wall Street doesn't have a brand we'd trust with anything else. Would you guys fly Wall Street Airlines? They're like, hey, most of the time we get you there. You're going to take your kids to Wall Street daycare? Be like, oh, we lost 8% of your child today. Who's going to Wall Street Hospital for surgery? You go in for like a knee surgery and you'd end up with a kidney transplant and they would just have stolen your kidney. That's Wall Street, and that's where people are putting their money. Are you kidding me? No wonder we're not getting results, right? So the fourth step that no one really talks about is if you have a business, then you can invest in yourself in that business to make more money. And a small business has a bigger chance to grow because of the opportunity in the market than a massive business like Apple, who, if they want to double, they've got to grow by $1 trillion. That's going to be awfully hard to do. So small business has more upside, but they don't want you to believe in yourself. They want you to think it's too complicated. They want you to think that if you just go get a job, that creates safety and stability. But you know what? It also creates a lot of misery for a lot of people trading their time for money in something that doesn't tap into their skill sets. So scaling revenue in a way that invests in yourself and increases your skill sets is the game changer. And then the fifth thing, so the first was to plug financial leaks. The second was to engineer wealth. The third was to accelerate investment income and turn all your lazy assets into cash flowing assets. The fourth is to scale revenue. And if you own a business, you can do that most effectively. And the fifth thing is to treat yourself as your greatest asset, to make life count, to take some time off so you're rejuvenated, you're relaxed, you're basically, you have enough recreation in your life that when you show up the best version of who you are rather than fatigued.
Hey, thanks for watching. I have to admit, I do enjoy to see the number of comments. I do enjoy seeing the number of views. It really feels good to know that this content's getting out there and it's impacting someone. I've dedicated a quarter of a century to this, dissecting it, asking questions, learning from the very best minds I could possibly find, and it's great to be able to share this with you. So this is just a simple thank you. I appreciate you.